So we'll just quickly look at BEDS following their recent results for FY22. So it was their first half results. So just starting off with the executive summary. So our investment thesis is centered around a couple of things. So we see the company as a high quality stock with solid cash generation, high dividend payout, as well as strong returns. Traditionally, we've seen this company as moat being combustibles. This is evidenced by high pricing and growing margins. But in the period from last year, during COVID times, we've seen this moat being challenged. Now we're seeing consumers moving more to alternative products, which are risk-reduced products or next-generation products. So there's two ways to look at this. So firstly, we're expecting to see volumes decline in the industry as a whole when it comes to cigarettes, given that we're seeing consumers switching from cigarettes to healthier alternatives, which is NGPs. Secondly, which is more a positive takeaway, is that your NGPs, as we've seen in Philip Morris, for instance, they command higher GP margins. So this will be enhancing in terms of margins going forward for the company. So one thing that we've highlighted as a risk is the pricing in cigarettes, which is something that we think is going to come under pressure given the regulatory issues surrounding tobacco products now. And it's become topical now as the EU as well as the US are focusing a lot on the tobacco stocks, trying to shift smokers towards the NGPs. So in the short term, because of this, we're likely to see margins not expanding as much for BEDS, given that they are still investing towards their NGP products. But what was interesting to note was that in their recent results, they actually had a decline in terms of losses they were making in their NGP products, which will benefit short term. So in terms of our preferences, so we prefer BEDS over Philip Morris. This is because the company is trading at a discount, and also we're seeing an upside potential on the back of the expansion of the NGP products. For Philip Morris, as much as we like the stock, we think that the upside is limited right now. You remember that we had the appraisal recently where we're looking at how the company will look like post its acquisition of Swedish Match. And what we're expecting is that the margins will increase slightly, given that Swedish Match is trading at higher margins compared to Philip Morris, which will benefit the company. It's just that for now, the upside is limited when you look at our intrinsic. So if we move straight to the recent results, one thing to note is our results are expressed in rands. So there will be a slight difference with the reported numbers. So the revenue was up 5% for the period. The key drivers was next generation products growing around 5% to contribute close to 50% to group revenue. Combustible revenues was down 4.2%. This was mostly because US was down around 30%. We'll remember that bulk of the business comes from the US. So that's why then net for net, the combustible volumes were down 4.5%. Another detractor was Ukraine as well as Russia tensions, and that led to an impairment of just shy of 1 billion in the period. So also, just speaking to the top line, the pricing for combustibles remained at around 4.8%, but for the group as a whole, pricing was at around 6.8%, which is decent when you're looking at the industry as a whole. Operating margin remained flat, with margin contracting to around 41%. Net income grew by 6%, and margin contracted slightly by 50 basis points. So net for net, your adjusted diluted EPS expanded by around 8%. Here we're just showing how the company performed against the market or consensus. And you can see it was largely a beat, except for the EBIT margin, which had a miss, and this was because of the impairment, which is once-off. Another thing that's interesting to note here is your Americas, for instance, performed very well. But if we look at the product mix for all of these divisions, so your USA was the one that had issues around the combustibles. Their combustibles, as I've said, were down 13.4%. But what's interesting to note, they still had a margin expanding, given that their smokers, which were in cigarettes, actually moved to the alternative, the healthier alternatives, your NGPs. Here we're just showing the momentum of the NGPs. As you can see, the group has come a long way. So what we're expecting for the full year, though, is for this percentage to normalize to around 10 to 11%. And this is because why we think why it was this high this period is because cigarettes struggled during the period, but as they recover in the second half of the year, we expect this number to come down slightly. And then in terms of how the market reacted to the stock, so it was slightly down 1%. And this is because of the weaker volumes that we saw in combustibles. And we'll remember, as I've said, that for British American Tobacco specifically, they pride themselves in their combustibles portfolio. It's been at the center of their moat. So that's why the market was nervous following the results. In terms of how the company has performed since our last report in March, it's actually outperformed the benchmark. And in terms of the earnings going forward for the full year, there's an upward trend as the market is expecting to see more contribution coming from NGPs, which will help expand the margins. In terms of our valuation, so we've used the DCF to value this company. So the multiple that you're seeing there is your EV to free cash flow. So in terms of our bull bear case scenario, we use one standard deviation up and down, base being the 5-year average. So what we're expecting, as you can see, in terms of our weighting being geared towards your bull case scenario, is that we'll see strong momentum for NGPs continuing as British American Tobacco has enough base coming from combustible to help accelerate growth into the NGPs. The caveat to that is that base that I'm speaking of, it will actually be, they'll be switching from your cigarettes. So we'll still see a decline in the volumes for cigarettes while the NGP momentum continues. Net for net, then we have an upside of around 12.3% on the company to our intrinsic of around 798.96 rands. Here we're just showing our bull case scenario. So if we continue to see the strong momentum in NGPs, we're likely to see an upside of around 26% to our intrinsic value. And for the bear case scenario, this plays out if British American Tobacco is not able to absorb or keep the market share that it's losing from cigarettes within its NGPs, then it will face the bear case scenario. But again, we don't think that is something that's more probable. That's the lower weighting on it.